The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning to you all. I hope you're all in fine festival today, as indeed is Carolyn Roth and myself, Steve Sedgwick, and you are watching Scorebox, and these are your headlines. How about this one? Tesla stock surges 21.9%. Shall I say that again? 21.9% for its biggest one-day gain in over a decade. Wow. As US equities try to avoid their first negative week in 6. The IMF is warning European growth will fall further behind the United States as the ECB's Pierre Wunsch tells this channel he would need to see the data moving in the wrong direction before considering a 50 basis point rate cut.
There might be discussion indeed on whether we need to remove restriction faster than we thought or not, again depending on the data. A 50-point move would be a big move.
Japanese voters prepared to head to the polls this weekend as the country's ruling LDP party stares down its toughest challenge in over a decade. A U.S. court blocks a tie-up between Coach owner Tapestry and Michael Kors parent Capri, sending the stocks in opposite direction after hours.
Our third headline today was Pierre Wunsch saying I would need to see the data in the wrong direction before I consider a 50 basis point cut. Well, Herr Wunsch, I hope you're watching, because Mercedes-Benz, one of the stalwarts of the European economy, has just reported a decline in earnings of 64% in the third quarter. Does that look like the data in the wrong direction, Herr Wunsch? I don't know, but look, 64% decline on weak luxury demand in China. Now, to be fair, I have no idea where the shares are going to move today because we've had the warning from the Stuttgart-based Mercedes-Benz on the 20th of September as well. Weak outlook, weak Chinese demand, real concern about the EV transition as well. So how much of the news has already preceded today's announcement? Well, I'll leave that for you to decide, the investor. But let's go through the details. Third quarter group EBIT, 2.5 billion euros. It was 4.8 a year ago. So should we say it's halved? Let's do that. Third quarter group sales, 34.5 billion euros. That's versus 37 billion euros the previous year. The car division, an adjusted EBIT of 1.2 billion. That is roughly, by my schoolboy maths, around about a third of the 3.3 billion we saw a year ago. The group outlook on EBIT and free cash flow remains in line with what they told us in the middle of September. So my question is this more bad news, or actually is it the same bad news, having pre-warned in the middle of September? Do you want to have a chip in on this one?
Absolutely. I mean, this is a very similar conversation to what we had about the luxury stocks yesterday. We're looking for the bottom here when it comes to China. We're looking for the bottom when it comes to the weak consumer demand. Mercedes has warned a couple times this quarter. This is obviously not the first time we're hearing about the bad news. So I think, to your point, this might all be priced in. But in terms of valuation of some of the auto stocks, low single digits, as you've always been pointing out. And the question is whether it is a buy or whether we continue to sell at these levels.
Well, let me give a very, very tiny bit of analysis on the stock just to contribute to that. Actually, year to date, the stock is only down 6.7%. But when you look at the move of this stock compared to its highs, I mean, again, it's actually one of the more moderate declines compared with others in the sector. Great chart on the board now. That kind of shows it really. Mid to high 70 euro range. Now only down as low as 54 euros, by the way, which happened the day after that warning on the 20th of September. In terms of the valuation of the stock, trades at, and I'll just give you the price earnings, which I'm actually going to struggle to do so here. Hang on a second.
We'll get to that later.
6.09.
There you go.
Actually more of a premium to some of the names like Renault, who actually had quite good news this week, and some of the others in this sector as well. So trades at 6.09 times forward PE, which is a fraction of the next stock you're going to mention, a technology stock that dabbles in cars.
Yes, the next stock added $140 billion in market cap yesterday. That stock, of course, is Tesla, up by almost 22% in yesterday's trading session. We talked about
that's over twice the market valuation of Mercedes.
Well, there you go.
They added in one day. Sorry, I'd interrupt. I just thought the stat is amazing.
You can interrupt me anytime.
Oh, well, don't say that. Don't say that. There are people who have ended their careers trying to get me to. But 62 billion is the, as of yesterday, market cap of Merck. Tesla, just think about the Merck is one of the great illustrious names of automobile history. Yesterday in one session, Mercedes-Benz, added double the value of Merck and then some in one session.
The biggest daily gain in 1 decade, and this is on the back of the very bullish outlook that Elon Musk gave us. Is it too bullish? We'll have to see here. But this obviously propelled the S&P higher in yesterday's trading session, which snapped back after 3 days of losses. Let's show you the U.S. markets week to date, because we've seen the markets suffering. Obviously, they were rattled by the higher bond yields. We'll get to that in just a second. But for the week, we are on track for some modest losses here for the U.S. markets. Let's get to bond yields, because obviously this was the domineering story of the week, with the backup in yields when it came to the 10-year at a 3-month high, obviously, and that has very much sapped the risk appetite when it comes to these equity markets. We'll talk about it with our guests in just a second here. I want to show you the 10-year Treasury yield. It is back below the crucial 4.2% level that it took out earlier this week. Why did we see this backup in yields? Well, obviously, expectations of a Trump win, more inflationary policies, but also the toning down of expectations of further big moves by the Fed to the downside. Let's push on to the Asian trading session and see what we're looking at. Here is a bit of a mixed picture. The Nikkei 2 to 5 struggling in the face of a higher yen, given the weakness that we've seen in the dollar. We're going into the lower house elections this weekend.
And just adding to the firmness in those yields, the initial jobless claims. All you lot to tell me how weak the US job market is. Well, you're not looking at all the data, are you? Looking at very specific data, I would suggest. US initial jobless claims unexpectedly fell last week, okay? It fell to 227,000, impacted by recent hurricanes in part of the country. Continuing claims rose to just under 1.9 million. Now, that did hit their highest level since 2021, so very mixed data. Loads of questions for Alex Morris, the CIO at FM Investments as well. Hi, Alex. So much to talk to you about. Look, we'll do the macro and the bigger picture stuff in a moment. What does a 21.92%, I think it was, move in Tesla to the upside on the back of a man who promises a lot of ways and sometimes delivers, sometimes? What does that tell you about the broader market?
It tells me that I should be holding Tesla stock, and even if I want to look away sometimes. But the market has always been volatile around this name, so it's not surprising, but you have to give it to them. There were some great numbers that were posted, and this market has been very reactive to good numbers. So it all kind of neatly hangs together, even though you might have to squint a bit and cock your head a bit to the left and wonder why. But all of that has been relatively consistent over the past few years. But it is also showing a market that really wants to see something happen. It wants to see a big number, and it wants to reward those stocks that do well. Similarly, when you show a bad number, it wants to penalize you. And as you're talking about earlier, I think Mercedes-Benz is about to feel the other side of that coin.
Yeah, Alex, I struggle to do one job. I really do. Ask my colleagues. I don't know how I could be a Republican campaign raiser and run about 4 other companies as well. I've got to hand it to the guy. Maybe he's worth $50 billion from Tesla. Oh, he's already got that. Okay, so tell me about the politics and how the top-down politics. We're days away. I can't believe it. We're less than 2 weeks away. How is that affecting markets? Because it really appears to be, especially Forex, especially the bond market, and now the equity market is even beginning to have a look at it.
Yeah, I mean, certainly we're starting to count the hours here in hundreds as to what is going to happen. Early voting is starting across the country, which, it seems kind of odd to cast your vote now, even though you might have a few days to learn something really important. But the markets are starting to take notice of it. There's been a lot of repricing into the Trump trade, which in theory is bad for equities and a bear steepener. We see bits of that. But, last time Donald Trump won, the market did the exact opposite of what all of the conventional wisdom was going into it. I have to expect the same is true here. But there seems to be a dislocation between what both candidates are saying and what the market wants to believe. Contrary to popular belief, neither candidate is running on fiscal responsibility. Both of their policies ultimately risk a reflation surge, and the market doesn't seem to much care for that. The Fed, though, they're watching, and I'm confident that they're trying to work out what needs to happen to keep their engineered soft landing well on target. And that might get a lot harder in the next few weeks.
Alex, this is Carolyn. So what do you do in terms of your positioning going into the elections and throughout the election cycle? Obviously, we may not get a result on the day. It may take a couple days or weeks even. Do you, John, is the trend your friend here? Do you want to be long U.S. equities? Do you want to bet on a steeper curve here? What do you want to do?
I think you want to stay long U.S. equities simply because being short it is a risk. I like staying, on the short end of the curve to the belly of the curve. That sort of trade feels like it's still going to work out very well. There's some carry risk also in just general bonds where you can't be short them, so you might as well just follow along, at least at equal weight to the market. Because regardless of who wins, Donald Trump wins, there's going to be a lot of trading action in the day or two that follows. If Donald Trump doesn't win right away, there's a good chance that he declares victory anyhow, and we spend the next few weeks sorting out what happens. And that volatility won't last that entire period of time. During the following week or so, the market will somewhat grow tired of it, I suspect, and go back to trading on fundamentals. And the economy, broadly speaking, is still strong, minus some noisiness in the numbers we get from the BLS and a handful of other metrics. Things are still going well. Companies are producing great results. We saw that today with Tesla. We're going to see that with more companies. Even your NVIDIA position is still up tremendously and poised to go up even further. So I think it makes sense to just kind of stay bullish on this market in general and just hope that it pushes through the election noise, which historically it's always done a pretty good job of.
Alex, if I take a look at the Treasury curve, you're getting a lot of yield when it comes to the 2-year. You're getting a very juicy yield when it comes to the 10-year. Why even branch out, let's say, to high yield where you're not fully compensated for the risk?
The high yield has been sort of underappreciated, but now it's priced very, very well. So we sort of like sticking around the Treasury space. If you want a little more yield, go into the investment grade space. There's a lot of high yield, longer term benefit. You're not going to see that in the next few weeks. But if you're looking for your portfolio positioning for the next few years from now, you certainly want to make sure you're not missing out on what are going to be some pretty attractive coupon rates coming out in December and into 2025.
Alex, we've got to let you go. Lovely to see you, sir. Thank you very much indeed. And now I see you, and I see you're from Chicago as well. Of course, we talked about this previously, or you're in Chicago. What a city. I've just come back a couple of weeks. My goodness me. Fulton Market, Pilsen, Chinatown, everything about it. The Loop, I loved it. So great city to be in, Alex.
Absolutely. Thanks for having me.
You're very welcome, sir. Alex Morris, CEO at FM Investments. You must know Chicago.
I know Chicago. I lived close by for a while. Have you seen The Bear? The best show on the planet.
I haven't.
You need to watch it.
I haven't watched enough TV. I need to watch more TV.
You do. I mean, you're on TV a couple of hours every day.
Yeah, that's enough for everyone.
Watch The Bear and you will fall in love with Chicago.
I've already fallen in love with it. I think it's Can I say this? I think it's the best city in America.
Is it?
Best one I've been to. Although I haven't been to Nashville, and I know you know Nashville very well. So
I know
Nashville. I want to go down there. So I need to do more market research, but I loved it.
Let's travel more. Now, the IMF says it expects Europe's economy to grow by an average of 1.45% in the 10 years to 2029, well behind the estimated U.S. growth rate of around 2.3%. The fund's regional outlook report for Europe says the continent needs a larger and more integrated single market to achieve its full growth potential. Karen spoke to Eurogroup President Pascal Donoghue about competitiveness in the Eurozone, asking him what lessons the bloc has learned from the Draghi report.
Firstly, it's a reminder that we are not growing quickly enough, particularly as we compare ourselves to the rest of the world. Secondly, the report is a reminder that if we don't deal with growth, the impacts of that, while will be very serious for our economies, will have lots of other spillover effects to things that Europe really values, and not only our standard of living, but our place in the world. And then thirdly, the Draghi report outlined options that can be taken to change that. And particularly if I look at the area of capital markets, particularly if I look at the discussion that is underway regarding the future budget of the European Union. While of course there are differing views, there'll always be differing views in a collection of democracies. That report and a few other contributions has changed the tone and mood of those discussions. And I do believe it will be one of the reasons we'll have further structural change in Europe.
Karen also sat down with the Croatian National Bank Governor Boris Vučić and asked him whether incoming data could push the ECB to cut by 50 basis points in its December meeting.
I'm completely open to any discussion in December personally. I don't know what the decision will be, nor I think we should know at the moment, because we should wait. If we are data dependent, we should not now talk about 25 versus 50 or maybe a pause in December. Anything can happen depending on the incoming data. So we have to stay fully open until December and then see what the data will point to before the decision is made.
Fixed income markets are trying to calibrate where we go to from here based on the data, some of the signals they're getting from the central bank, and the view is that we could end up around 1.8%, somewhere around neutral. Some are saying we could end up below that, but the long end of the curve is now starting to reprice and repricing lower. Where do you think we're heading? Do we think we end up at terminal, or is it going to be a point where we have to go below terminal to provide some sort of stimulus?
It's still too early to say that. As we know, that rate itself changes over time. It's not a fixed point, so it's better to approach that level and then determine where it is, where we wanna stay. And this will change continuously over time. You know that people have tried to predict on the way up the terminal rate, and those that predicted early turned out to be pretty wrong. So better not try to predict it on the way down.
The National Bank of Belgium Governor Pierre Wunsch also spoke with Karen about the policy outlook and whether a 50 basis point rate cut is on the table.
If you say you are data dependent, you are data dependent. I don't want to anticipate on what the data are going to tell us. There might be a discussion indeed on whether we need to remove restriction faster than we thought or not, again, depending on the data. A 50-point move would be a big move, so I think it would only be justified if we have data which would be going down on inflation, but probably also in terms of GDP growth going in the wrong direction, which is not really what we see today. I mean, we have a PMI which was still below 50, but a little bit higher. To me, the base case is still that we have at some point a recovery in 25. And let's face it, we are very bad at spotting inflection points in the data. At some point, we see a recovery that we have not forecast. So let's be certainly open to that possibility as well.
I'm sensing some wariness with a jumbo-sized rate move, as it's often termed. However, the Federal Reserve managed to deftly cut rates by 50 basis points without any dramatic need to do so with growth crashing, for instance. That simply did not happen. Growth is intact, it's resilient. It managed to communicate this was simply about stepping closer to neutral. Why can't the ECB do the same?
Well, again, I'm not excluding anything, but we've started quite early in cutting rates. I think it's good if we can be gradual and not create volatility in the market that would be unwarranted. And again, we are data dependent, so the fact that we already would be discussing a 50 basis points cut in December, I really want to see the inflation number in October, the inflation number in November, see what the projection is, and then we will have a discussion on where we need to go. And most probably it will be, still cutting rates. I don't see today a need for a 50 basis points cut, but let's look at the data. I think we should not over dramatize. I mean, we're getting in a situation now where it's going to be about fine tuning of the rates depending on what we see. But basically, the good news, we are going to our 2% target a bit faster or not, we will see.
And we'll bring you more from Washington, D.C. on Monday, including Karen's conversation with the German finance minister, Christian Lindner. Steve.
Yeah, there's a man who could add a bit of stimulus if he were to choose to, but we've spoken about that a few times. Right, coming up on this show, it could all be changed in Japan as voters head to the polls in a general election this weekend. High-stakes gamble. We'll get the latest from Tokyo next. Plus, we're standing by for Sanofi numbers, which are set to cross the wires at the bottom of the hour. And we're getting a read on the European energy sector with Italgas CEO Paolo Gallo. That interview, exclusive interview, is coming up at 8:15 British summer time.
welcome back to the show. Japanese voters are heading to the polls this weekend to choose their next government. The ruling Liberal Democratic Party faces the prospect of a major defeat, which could lead it to lose a majority in parliament for the first time since 2012. Kaori and Joji joins us live from Tokyo. And Kaori, what's the magic number we're looking for here?
Well, Carolyn, the magic number that Ishiba, the prime minister here, is looking for is 233. The magic number is that figure is because it's a simple majority. The number of seats the ruling bloc has to win to keep a simple majority, but that even is lowballing it because at 233, it means the ruling coalition will be losing seats. So this was a gamble for Japanese Prime Minister Shigeru Ishiba, and it's going to be an uphill battle ahead of Sunday's vote. He is facing forces within opposition from within his own party who are vying to be the next leader of the LDP and possibly take over his job. So this is a fight for survival for his own position as well. On the other hand, you have the opposition, the Constitutional Democratic Party of Japan, possibly faring a lot better than expected, but we're not really at a point where you have a viable opposition. Having said that, if we hit that 233 mark or below, this could put Japan to a point of political turmoil, to the tune that we haven't seen in many, many years, and we could potentially see another period of revolving door premierships as we've seen in the past here in Japan. That would not come at a very good time. As you know, the IMF has lowered its growth targets for the Japanese economy. You had inflation coming in below that 2% target today for Tokyo CPI, and you have question marks about wage growth as well. There are two things that voters here want to see addressed. One is the fact that their wages are not going up, and the fact that prices are increasing, food prices and energy prices in particular. And on top of that, after these elections, 9 days after, you have the U.S. elections. And the prospect of potentially Donald Trump returning to the White House has people here, businessmen and politicians alike, very, very nervous. So a lot is hanging in the balance, not just for Shigeru Ishiba, but for his party as well.
Kaori, can I just ask you what the implications are for the BOJ? It's meeting next week, obviously. We're not expecting a change here. Initially, Ishiba was pretty hawkish. Then it turned very quickly into becoming pretty neutral, even dovish. What can we expect here?
Well, that's the thing. He's been walking back a lot of his positions that he was making before he became prime minister. And his position on where interest rates are headed from the Bank of Japan is one of them. Now, I think a lot depends. Of course, the Bank of Japan is independent from the political process here. But having said that, the economy needs to grow, obviously, for the Bank of Japan to raise interest rates further. So we're a bit of a stalemate right now as far as the Japanese economy is concerned. And the one factor that people, tend to overlook is the fact that the Japanese economy has always been very, very vulnerable and fragile to external shocks compared to other developed economies. So I think that's one factor that people have to consider when they look at when the Bank of Japan might start raising interest rates.
Kaori, as ever, fantastic. Thank you very much indeed. Do you know, Kaori, whenever your name is mentioned in the London newsroom, everyone just looks and goes, oh, the legendary Kaori and Joji. You've got so many fans here, genuinely. It's extraordinary. Me amongst them as well. Thanks, Kaori.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.